Most people treat a promotion like a math problem with one answer: more money, better title. Obviously, yes. The offer lands in your inbox and you feel it. The validation, the recognition, the sense that the work is finally paying off. You run the numbers on the salary increase. You think about what the new title looks like on LinkedIn. You imagine telling people what you do. And underneath all of that, there is a quiet assumption that this is just the next rung on a ladder that keeps going up. That the same thing that got you here, your skill, your output, your performance, is going to carry you through whatever comes next. That assumption is the most expensive one you will ever make. There is a mechanism built into almost every corporate structure that turns that obvious yes into a financial trap. Not because you are not talented, because of how talent actually works and how promotion systems are designed around a fundamental misunderstanding of it. Researchers published a study in the Quarterly Journal of Economics analyzing 53,000 workers across 200 firms. What they found was specific and uncomfortable. The better you perform in your current role, the higher the statistical probability that your next role will damage your earnings trajectory. Not accelerate it, damage it. That mechanism has a name. It is called the Peter Principle, and it is not corporate satire from the 1960s. It is a mathematical certainty operating in your career right now, whether you understand it or not. We're going to look at exactly how that mechanism works, what it actually costs in dollars, the number that never appears in any offer letter, and how to make the promotion calculation correctly, possibly for the first time. Let me be direct about something before we get into the mechanism. The promotion offer feels like validation. Someone saw what you've been doing. You worked hard, you delivered, you stayed late, you solved the problem nobody else could. You earned the recognition. That logic is real. Your performance is real. The feeling of forward momentum is real. None of that is wrong. What the logic misses and what costs people so much is that the new role is not a bigger version of the old one. It is a different game entirely. You go from executing technical work at a high level to managing the people who do that work, from being the analyst to managing analysts, from being the top salesperson to running the sales team. From writing the code to overseeing the engineers who write it, from playing the game to coaching it. These are not the same activity with more responsibility. They require a fundamentally different set of skills, a different kind of intelligence, and a different relationship with your own ego. The analyst, who is elite at identifying patterns in data, is not automatically equipped to give difficult feedback to a team member who is underperforming. The engineer who writes exceptional code is not automatically wired to spend 6 hours a day in budget meetings and performance reviews. The skills that made you exceptional at level 1 have almost no predictive relationship with the skills required at level 2. And the corporate ladder does not explain that. It just moves you to the next rung, adds a title, increases the salary, and expects you to figure out the rest. The gap between what made you great and what the new role actually demands has a specific financial cost. Most people do not calculate it until they are already inside the role, and by then it is expensive to leave. Here is the core principle that makes the Peter Principle a mechanism rather than just a metaphor. Performance is role specific, not portable. Think about a professional athlete who is elite at one position. Their skills are genuinely exceptional, but exceptional at that specific thing, in that specific context, against opponents who are playing the same game. If you move that athlete to a completely different position, those skills do not automatically transfer. An elite shooting guard does not become an elite point guard just because they are exceptional. The physical abilities may be similar. The instincts are completely different. The reads, the timing, the decision-making, all of it has to be rebuilt from the ground up. Corporate structures do the exact same thing. They call it a promotion and attach a salary increase to make it feel like continuity. In the QJE study of 53,000 workers across 200 firms, researchers specifically focused on salespeople and their transition into management. Sales was the right place to test this because it is the most measurable job in any company. You either hit your number or you did not. The data is clean, the performance is quantifiable, and the results are difficult to argue with. What they found was a clear negative correlation. The best individual salespeople, when promoted to sales manager, consistently led teams that perform measurably worse than teams led by average salespeople. Not slightly worse, not occasionally worse, consistently, measurably, statistically worse across hundreds of firms. The researchers dug into why. The explanation is structural. Top individual sales performance requires aggression, competitive instinct, a focus that borders on selfishness, and a drive to close that supersedes everything else. A great salesperson is fundamentally oriented toward their own output. That orientation is a feature, not a bug, in an individual contributor role. Managing people requires almost exactly the opposite orientation. It requires patience with the person who is not yet where you need them to be. It requires the ability to subordinate your own instincts and performance ego to someone else's development arc. It requires a tolerance for conflict that is not about winning a deal, but about navigating the friction between two human beings who need to work together. It requires the kind of administrative endurance that top performers usually find genuinely suffocating. The skills that made you the best at the individual role are not neutral in the management role. They actively work against it. The company took its highest revenue generator off the field and placed them in a position where their instincts created friction instead of output. Double value destruction. The best producer is removed from production, and the team they are now managing performs worse than it would under someone average. And companies kept doing it, not because they were naive, because the only visible metric in the system was individual performance in the current role. The system was selecting for the wrong variable by design. The study also found what actually predicts good management performance. It was not total sales volume. It was the salespeople who had a consistent history of collaborating on complex deals, even when their individual numbers were not the highest. The ones who had learned to share credit, coordinate across teams, and coach others through difficult accounts. Those qualities predicted management success. But those people rarely got promoted because the system could not see that. The system could only see who sold the most. The promotion system is blind to the gap. It rewards what you did. It does not measure whether what you did has any relationship to what the next role requires. The standard career advice is say yes to every opportunity, keep climbing. Growth happens outside your comfort zone. You can learn the new skills. You are smart enough to figure it out. That advice is not wrong in every context. Growth does require discomfort. People do adapt. Learning happens at the edge of competence, but it is answering the wrong question. The question is not, can you grow? The question is, does the financial math of this specific promotion actually work in your favor when you run all the numbers? Not just the ones in the offer letter. The calculation most people never run. The average promotion comes with a 15 to 20% salary increase. On a $70,000 base salary, that is roughly $10,500 to $14,000 per year before taxes. After income tax, at a standard effective rate, you are looking at closer to $7,000 to $9,500 in net take-home per year. That is $580 to $790 per month. On paper, this looks meaningful. In practice, something else happens almost immediately. Research on lifestyle inflation, the well-documented tendency for spending to rise proportionally with income, shows that within 24 months of a salary increase, the average professional has absorbed 70 to 80% of that raise into fixed expenses. A better apartment, a car upgrade, eating out more frequently, subscriptions and conveniences that would have felt like luxuries at the previous salary but now feel standard. The net financial gain from the promotion after lifestyle inflation runs its course over 2 years typically settles closer to $1,200 to $4,000 per year after taxes. That is roughly $100 to $330 per month in actual new wealth building capacity. Now look at the other side of the same ledger. In technology, financial services, and increasingly in consulting and media, the senior individual contributor track has become one of the highest paying career paths available. Senior ICs, the people who stay in their technical lane, develop deep specialized expertise, and become genuinely elite at the core work, routinely out-earn their manager counterparts by $40,000 to $60,000 per year, once you account for the full compensation picture. Performance bonuses for technical specialists often exceed management bonuses because the individual's output is directly measurable. Equity compensation at technology companies is routinely higher for senior engineers than for the managers above them. Specialized skill premiums, the additional pay that comes from being genuinely irreplaceable at a specific technical function, can add $20,000 to $40,000 annually on top of base salary. The manager coordinates the people who generate the value. The senior IC generates it directly. The market, at the upper end of most technical fields, pays more for the generator than for the coordinator. The promotion that appeared to be a $10,000 raise is, in many cases, a $40,000 to $60,000 annual wealth gap in the wrong direction. And it compounds with every year you stay in the management role instead of developing deeper expertise in the individual contributor lane. There is also a second variable that almost nobody discusses when they are sitting across from the offer letter. The management role comes with a different risk profile. Individual contributors who are excellent at their work have very high job security. The company knows exactly what they produce. The output is measurable and visible. During downturns, the people who build the product and generate the revenue are the last to be cut. They are protected by their own output. Managers operate in a fundamentally different risk environment. Their output is indirect, mediated through the performance of the people they manage. In a downturn, middle management is typically the first layer cut. The logic is straightforward. If the company needs to reduce costs, removing a layer of coordination is less visible in the short term than removing the people who generate the product directly. The individual contributor who stayed in their lane has higher earning potential and lower career risk. The promotion that appeared to be an upgrade on both dimensions may have been a downgrade on both. That combination of numbers does not appear in the offer letter. Now we get to the number that is almost never calculated. What happens when the promotion does not work out? This is not a rare scenario. Given everything we have established, the negative correlation between individual performance and management effectiveness, the regression to the mean, the skill mismatch, the failure rate for promoted high performers is structurally high. It is not a failure of character. It is a failure of role alignment. But the financial consequences are real, regardless of the cause. Managers who are separated from a role they were promoted into, whether through demotion, being pushed out, or restructuring, typically see a 15 to 25% salary reduction in their next position, not back to where they were before the promotion, below it. The market reads that resume with a specific lens. Here is a candidate who was performing well as an individual contributor. They were promoted into a management role. They did not succeed in that role. What the next hiring manager sees is ambiguity about both the management capability and, critically, whether the individual contributor skills are still current. Time spent in management is time not spent sharpening the technical edge. Skills atrophy, tools and methods evolve. The market discounts accordingly. Meanwhile, the lifestyle that came with the management salary does not compress automatically when the income drops. The apartment is still leased at the higher rate. The car payment is still running. The fixed monthly structure that expanded to match the promotion salary does not shrink because the next job pays less. It stays. And the gap between income and expenses becomes a structural financial problem that persists for years. The total financial impact of a failed promotion, when you account for the salary reduction in the next role, the lifestyle inflation that was not reversible, and the opportunity cost of the senior IC track that was abandoned, often runs $80,000 to $150,000 across 3 years. Nobody presents that number when they slide the offer letter across the table. Nobody models what happens if the promotion does not work. The conversation is framed entirely around the upside. The downside calculation is left to you. I want to address something directly. The downside calculation is left to you. I want to address something directly here because this is the point where the argument gets misread. This is not a case against ambition. This is not a case against promotion. This is not an argument that you should never advance in your career. Some people genuinely want to lead teams, develop other people, and operate at the strategic level. For those people, management is not a trap. It is the right role. The mechanism works in their favor. Their skills align with the new requirements. Their energy comes from the work the role actually demands. The Peter Principle is a trap, specifically for people who take the promotion primarily for the money and the title, when the financial math does not actually support that decision, and when the role itself is not what they genuinely want to be doing every day. The distinction matters more than it sounds. A promotion you want because of what you would be doing, the actual work, the actual function, is a completely different financial and psychological calculation. Promotion you are accepting because the ladder goes up and you have been conditioned to climb it. The mechanism does not care which situation you are in. It runs either way. The question is whether you have run the math before you answer. Let me apply this to 3 situations that are likely present in this conversation right now. Situation 1, you have a promotion offer on the table. The salary increase is real and you're excited about it. But when you think honestly about the day-to-day reality of the new role, the meetings, the performance reviews, the people management, there is hesitation underneath the excitement. Before you answer, run the full financial model. Take the net salary increase after taxes. Apply a 70% lifestyle inflation factor over 24 months. Calculate your actual net new wealth building capacity. Then look at what the senior IC ceiling in your current function looks like at full optimization. The bonus potential, the equity, the specialist, premium. Compare those 2 trajectories over a 5-year window. If the IC track outperforms the management track in that window, and if you are not genuinely drawn to the management work itself, you now have a number to anchor the conversation. The number tells you what the feeling cannot. Situation 2, you are already in a management role and you recognize this pattern in yourself. The work does not energize you the way the technical role did. You are working harder for outputs that feel less visible, less personal, and less connected to the thing that made you good at what you do. You feel like you are managing the edges of other people's work rather than doing your own. The path forward is not to wait for a separation that damages your trajectory. It is to initiate what is called a skills audit conversation. You go to your manager and you make the case for a senior IC track. Not as a demotion, not as an admission of failure, but as a strategic reallocation of your highest value output. The framing is, the company needs more of what I am genuinely exceptional at. Let's build a structure that maximizes that. The best version of me generates more value here than the average version of me does in a management role. That is not a retreat. That is a correction. Situation 3, you are not at this decision point yet. You are performing well in your current role. You are likely to receive a promotion offer at some point in the next year or 2, and you have not thought carefully about where your competence curve actually peaks. The most valuable thing you can do right now, before the offer arrives, before the social pressure kicks in, before the excitement of being selected makes clear thinking difficult, is to identify your zone, not in abstract terms, specifically. What kind of work puts you in complete focus and generates your best output? What are the tasks you do where time disappears and you feel genuinely competent? What is the function where you are not just good, but structurally difficult to replace? That is your zone. Build toward the senior version of that. The Peter Principle cannot trap you if you already know where the edge is and have decided in advance and in calm what you want to do when you reach it. The common thread across all 3 situations is the same. The question is never simply, should I keep climbing? The question is, where does my specific competence curve peak? And am I currently being compensated at the level that zone can actually generate if I develop it fully? Here is the mental model that makes this operational. Think of your career as existing in 3 zones, not rungs on a ladder that you simply climb in sequence. Zone 1, development. You are still building the core skill. Every week you are measurably better than the week before. The feedback loop is fast. The progress is visible. You're investing in a capability that does not yet exist at its full level. This zone has a ceiling. You will reach it. You will know when you do, because the rate of visible improvement flattens out and the work begins to feel like execution rather than discovery. Zone 2, peak competence. This is your zone of genius. The work matches the way your mind is wired. You are fast, precise, and energized by the challenge. You operate at a level that is structurally difficult to replace. You see things in your domain that others do not see. You solve problems that others cannot solve at your speed or at your depth. This is the zone that generates the most financial value. And it is the zone that the corporate promotion system is designed to move you out of, often before you've fully developed the compensation structure around it. Zone 3, the Peter zone, the role has outpaced the skill set. You are working harder and producing less. The feedback loop has inverted. You're getting negative signals from the environment, but the path back is not clear. Every day costs more energy than it returns. The work that used to feel generative now feels like attrition. This is not a character failure. It is a structural outcome of a system that promotes based on past performance rather than future role alignment. The promotion system moves people through all 3 zones in sequence, as efficiently as possible. Most people spend too little time in zone 2 because the system keeps pulling them towards zone 3 before they have extracted the full financial value of their peak. Your job is to identify zone 2, to locate it precisely, understand exactly what generates your best output within it, and build a compensation structure around it before the system moves you past it. The most financially resilient person in any organization is rarely the highest ranking one. It is the person who found their peak competence, understood the full market value of that peak, got paid for it at the highest sustainable level, and had the discipline to stay there, instead of being pulled upward by a system that could not see what it was taking from them. They do not need titles to validate them. They are not climbing because the ladder goes up. They are the person the organization cannot replace, which makes them the last one cut, the first one retained, and the one with the most negotiating leverage when the market eventually shifts. The Peter Principle assumes everyone is climbing automatically. Not everyone has to be. The system does not care about your title. It cares about what you produce. Operate accordingly. The financial operator. We don't sell dreams. We explain systems